Top stocks to buy for 2022, and we're going to start right now. Domino's Pizza. So everyone's familiar with the name. What a lot of people are not familiar with is that this has been one of the best performing stocks of the decade. No one really pays attention to this at all, but we're going to pay attention to it here. I'm going to talk to you about why it made the list and what I think is going to happen here. So let's just start with this, just so people can get the perspective. You've never really heard it mentioned, but from 2010, actually, it's from 2010, from here to here, every dollar you invested is up substantially. If you put $1,000 in it back then, it's worth $20,000 at this point. It's absolutely insane. So there's a lot going on with the company, and we're going to dive into the fundamentals in just a minute, but let's talk about it technically. So this is from our newsletter. If you don't get the newsletter, you're definitely going to want to subscribe to it. There's a free version that comes out, and the link will be in the bio, or in the description rather. You're going to want to subscribe to it because I'm investing in these companies, and we're going to track them weekly, as I stated in the previous part 1 video. But let's just talk about this for a second. Now, here's your wedge line. This was our initial break, but look at what we've done here and how we've formed this flag. Now, this is a pretty significant pattern. We're looking long term, but I'm going to just address this pattern. When you have a bearish engulfing, and again, all these videos connect. So if you've missed some of the installments or volumes, I strongly recommend you watch the candlestick videos that I did. The patterns are significant, and they'll help you greatly, especially if you're new. So you see how you've encompassed right here on that green, right? And then you can see how this is coming in right there. And I'll zoom in on this for a moment, and we'll just take a minute with it. So you can see how this bar completely encompasses that bar. Now look at the next bar. It almost encompasses it. Whenever you have a reversal like that, you're getting ready for a really powerful move. And I showed this in the last video, and I'll show it to you here too. And you're starting to get a little bit of a megaphone here. So I would watch this very closely on the short term. I think this is setting up for a very large move, and I'm going to explain why in a moment. But let's just go back and look at this on the weekly. Now, this is your level, straight across, and it's clean. It's broken. There's very little to say about it. It looks excellent. Okay. Now, if you understand this company and you understand where the growth is going to come from, this is pretty significant stuff. So let's just get into it. Okay. So they have a very good culture. And I just want to walk through a portion of this because it's kind of a feel-good story. A lot of people are not even aware, this is from mid-November, but a lot of people are not even aware that they're the largest pizza company in the world, globally. Okay. So most people just think of it as the U.S., but when you see the next slide, it's very interesting how small market share is globally of pizza companies. But they did this where they went out and all these different restaurants in Boston, Phoenix, Louisville, Denver, and they put these gift cards for local restaurants to drive traffic to them because they're getting killed by Grubhub and Uber Eats and companies like that. So it just speaks to the culture of the company. I thought it's somewhat important for people to understand and look at the company. This gentleman put a really good piece together. I'm only going to get into the main pieces right here because some of it I just think it's just too in-depth. We really don't need to go down that road. But if you look at the global pizza market and what we're looking for as far as growth, and the amount of money that's there, the U.S. is, I agree with what he's saying here, the U.S. is saturated. You cannot throw a rock without hitting a pizza place. The rest of the world, not so much. Now, if you walk through a couple key factors here, international pizza delivery is underdeveloped at this point, and DPZ is rapidly expanding their presence across the world. Okay, so let's get into that. Global pizza market growing 10.17% and is expected to reach $230 billion by 2023. That's an enormous market, okay? And it's important to understand that out of all these companies, the Papa John's, the Pizza Huts, Domino's is growing at this average of 13.25%. They are just crushing people. Now, if you look at the pizza industry worldwide and where all that money is coming from, it's Western Europe and North America. The rest of the world is completely unaffected by it. So this has a huge market, and this is really what they're pushing into. So just a couple other quick things that are pretty significant that I think people should focus on here. So their profit margin is 11.59%, significantly higher than the median of 6.6. Papa John's International is 5.4%. So when you're looking at this, you have an industry that is growing, expanding internationally. On top of that international expansion, it has 2x the gross margins of its closest competitor. Okay, so there's a lot of value here, and this is a perfect stock to own going into next year because it's just going to be consistent, sustainable growth. And as you remember from the first video, all these stocks are going to have something in common. They're going to be market dominant, right? Because we're going to be trading them all year long. We're going to have a position in them all year long. Make sure you watch the first video because I'm not going to get into all of it again, but you really want to understand what's going on. And I'll link the first video at the end of this in case you missed it. But market dominance. We want high barriers to entry. Okay, it's going to be very hard to play with Domino's supply line. That's what we're looking for. Stocks that can actually change and affect the world globally. That's what we're looking for. Sometimes it's tech, sometimes it's pizza. Next up on the list is ARK. This is the flagship fund of ARK Invest. And the reason for this, and everyone knows who Cathie Wood is, but the reason for this is relatively simple. I do believe that the assets that she's holding underneath are probably very depressed. And we just don't know which one of those assets is going to come out and be the leader. And we're going to go through her holdings in this in a moment and show you why it ranks as one of the top. Now, this becomes a great vehicle, as you know from the previous video. This becomes a great vehicle that if I want to increase performance and have more diversification during this year, this is an excellent vehicle to do that in. If I want to increase the performance of some of the other names that we're going to go over, I can do that as well. So that's how we're going to start positioning the portfolio a little bit. And we're going to discuss positioning and how to do long-term holds throughout the entire year. That's why I stated you're going to want to subscribe and click notifications to this and follow along. So let's get back to it. ARK. And let's just start with the basics. Okay, here we are in the weekly. October 12th, cuts, undercut, bear flag. Okay, not what we want to see. Here you are with a doji. Isn't it amazing what it looks like afterwards, how easy it is to spot the low? Here you are on a weekly doji, and then that doji flips, right? So pretty simple stuff when you go back in time, isn't it? But now you're seeing us move higher, and we got a little ahead of ourselves. And now we've come back down, and now we've corrected. And we've corrected to an area, right, that was pretty much September. Now, if we go back and take a look at it, it's still way above where we were before, but she was in the right names, and we're going to address that. And let's address that now, actually. So these are her holdings. So Tesla, Roku, which has gotten absolutely smashed, as we all know, TDOC, Zoom, Coin, which I think could be a dark horse this year, Unity Software, Spot, who has the single largest subscriber paid base in the world. So these are her top holdings. Now, she can change them at any time, but I think it's important to understand that 3 or 4 of her top holdings are pretty much bottomed out as far as going down. And they're really in what we would refer to as a stage 1 kind of position on those names. And by stage 1, I mean that they are starting to form a base. And I don't want to go through all of them, but just to give you an example, this has formed its double top and broken on Roku, and now you can see how we're going flat. So you're starting to see it with names like that, Spot. Okay, this is just basing. So this is an excellent place to build a position. And again, that's the whole purpose of this. Top stocks to buy, but to build positions in. So now that we know that and we know where we're at, we know what we're dealing with, and we know what levels we're going to have to look at as to whether we're going to add or subtract, just like on that flow chart I did in the previous video. So now that we have this, we can drill into this a little bit on the daily. And I'm just going to say this. I would not bet against this lady. Her understanding of what's going on out there and how this is all interconnected is pretty much unprecedented as far as running an ETF. It's usually somebody that's doing this that's got a very private hedge fund that's at her level or has that level of talent. It's very hard to keep this level of talent at an ETF company because you're not sharing you're sharing in the profit sharing, but you're not sharing in the actual asset, under management profit sharing, which is where they make all their money. So it's very hard to keep this talent, and it's a testament to her. But we're just basing right here, but let's just go through this statement today so you can kind of see where we're at and what she said, because I think this is pertinent. So today we learned that in November, and this was December 29th, retail inventories rose more than 2%, fastest pace since the 90s, while imports jumped 4.7% and exports dropped 2%. Okay, see how she's putting it all together? She's connecting all the dots, and then she's going to break it down into how she thinks it's going to affect her positions. Moreover, real consumption, including services, was flat, and savings rate dropped to 6.9%, below pre-COVID levels. This buildup, along with M&A and IPOs, reminds me of Y2K. It's very similar for those that didn't trade during that period of time. It's a pretty similar situation because there's a lot of uncertainty that's going around, and there was a lot of fear of inflation, which we're going to address in a moment. This time, the excesses are likely to be industries that technology will disrupt: energy, financial service, transportation, among others. If so, this disruption will be the flip side of Y2K, completing the circle. In our view, and this is important because Y2K, that was pretty much the end of the boom. And she's saying that this is the flip side. In our view, fears of inflation will give way to confusion and fears of recession during the next 3 to 6 months. If so, the rapid growth rates of truly innovative companies, many of their equities malaligned this year, should be rewarded handsomely. Okay, so I think it's important to understand where her head is and why this registers as one of the top ideas for next year. This is a perfect investment to continually, even if you don't follow along with what we're going to do this year, to kind of sock away money in dollar cost average, because some of her holdings are going to just excel. You have to understand this is a lady and a system that she has in place that got laughed at when she said Tesla was going to 4,000 or when she said Bitcoin was going to 50,000. So I'm not going to bet against her. I'm going to bet with her. Next up is Coinbase. So we saw from ARK-K that there's a position in this. Yes, we'll have some exposure that way, but there's a lot to this, and I'm more interested now in the company than I've ever been, and that's based upon some of the new markets that they're entering. And I think that their brand recognition, their name recognition, is really going to give them an edge. So we're going to discuss that in a moment, but let's just talk technicals for a minute. This is when the debacle happened, when they went public, and it was just straight selling. But during that time, something's emerged. We have just found this base, and we've been basing now for about 6 to 8 months, I would say, since we'll call it 8 months. And what you're seeing, we're seeing retest and bounce, retest and bounce. Now you have a little peak here, and it's the first time that this has happened since this rally. Now, if we just do something as simplistic as a wedge line, you can kind of see what's going on right here. This is price rejection. We know that from that previous video on candlesticks, so I'm not going to include it. Sometimes I can include them in the trend line. Sometimes I don't, and I'd have to do a whole video on why. But you can see pretty clearly the line, and you can see how my line is pretty accurate, right? So what we want to focus on is, well, why now? Well, a couple key things are going on. So just remember this peak for a moment on November 9th, okay? And let's just look at Bitcoin for a moment. So last time when this flew, Bitcoin was on fire, okay? And we can see that here, same kind of peak, November 9th, and now we're kind of bouncing down again on Bitcoin. So we're still coming in the same way, right? We're still following it. But what we're starting to do a little bit better is we're starting to kind of decouple from that. In other words, we're getting some spikes here, and we're getting some interest. And let's just put these indicators in for a moment. And we're going to throw the volume in as well and get rid of the RSI. And what we're doing is we're still seeing some spikes, even on the end of this week, which was very, very weak, and we're above the 21-day moving average. So we are in a position that is a little bit different than what's going on here. So we have a stronger relative strength, and I would argue that that makes it signs of a decoupling. So this fits perfectly into what we're looking for. Dominant companies, market share, changing things globally. Now, let's just look at a little bit of research, but let's do the weekly first so you can just kind of get a better picture. You rallied up, you tried. Everybody knows that this is a bearish hook reversal. I mean, you can see it pretty clearly. Comes back down and it's forming this little base right now. But let's just talk about this. So the top stock in Oppenheimer for the year, and this is from thestreet.com, it was issued a couple days ago. One of their top ideas is Coinbase, and it's because mainstreaming of digital assets blockchain. We believe the adoption of digital assets in both institutions and retailers will continue. That's a very important distinction. We're going to talk about that in a second. Web3, which is largely built on blockchain and focused on decentralization, will also help, obviously. Now, this was set up in October 12th, okay? Join the wait list. NFTs coming soon. Join the wait list. Okay. So let's go to this. Bloomberg article, October 13th, 8 p.m. Coinbase NFTs waitlist tops 1 million signups on first day. So within 24 hours, 1 million people signed up. And I'm going to show you why that's important in a moment. But there's the line down here that's very significant, and we're going to discuss it. Fees are more likely to mirror retail than institutional crypto trading. That's very important because there are fatter fees to retail than there are to crypto. NFT trading at our 3% fee estimate would bring in much more revenue per trading dollar, along with less volatility to Coinbase operations and the crypto trading platform. Okay, now what we're going to go through here are just some data points from Business of Apps that actually walks through some statistics. So at the time of this, they had 43 million users worldwide. Okay, so we're just going to kind of go through a couple things here to look at it. I don't want to get into all those details because I'd rather you see it here. Coinbase revenue. This is where they were in 16 to 17. So obviously you're going to have jumps. 18 stalled. We all know why 18 stalled and 19 stalled, because nobody wanted to be around it, because Bitcoin was trading very low in comparison to where it is now. Now we obviously got the Bitcoin bump on revenue, but look at these projections and what we're heading out for H1, right, of 2021. So I think that's really important to understand. Now, you can see that growth. Let's go look at the profit margins. Okay, they made a lot of money, and then Bitcoin came in and they took a big hit. Now we're talking about $2.3 billion, but it's even more interesting than that. This is their growth. Okay, so in 21, they're saying 56 million. So the growth of this is substantial. They're getting into other businesses that have higher gross margins than their current business. Now, this I thought was fascinating. And in talking to people, I understand why people are trading this stuff more and they're using this platform more, because they don't have to deal with all the issues that stock have. They have to deal with what is the technology, does it work, and is this something that could be hot? It's very different than buying stocks, and we're all aware of that. But just these monthly active users, I want to put this in perspective. From 2020 to 2021, their average monthly users that are active 4x'd. Okay, that's pretty substantial, and you can see that from the valuation that's going on. And look at the assets under management. They're almost 10x in a year. It's substantial. Now, you have to grow into a valuation like this, and you can just see some of the other data points right here, total transaction volume. But now, that's not saying that the stock is cheap. But what could happen is something very similar to what happened for those that remember this, when Google went public. Okay, you had to grow into it. I'm going to use the daily here. But you had to grow into that valuation. And I think that's exactly what you're doing here. And I think that's why we're going sideways. And we're going to work some of this off, form a huge base, and then we could have the potential for a breakout later in the year. Penn Gaming is next on the list. So Penn Gaming owns and operates racetracks all over. They're based in PA. But they have about 45, 46 facilities now, U.S., Canada. Some are under the Hollywood Casino brand, but they also have a 36% stake in Barstool Sports. So I'm going to give you a quick tip here in a moment how to figure out why we would buy this one over DraftKings. Just something very simple that you can do on your own. But what's important about this is this gives us exposure in two ways. Okay. First exposure is that we have places as travel opens up and we've started to see the travel stocks start to move and find bottoms. Even this is starting to do it, right? We're seeing that. You're seeing this this 21 point up. Let me just go here and very quickly just pull up the 8, see how that's going. We could see that cross. So we all know that's the first sign, right? We did that video on moving average crosses. So we all know that's the first sign that something may be beginning to turn. And again, we're here to build positions and trade around existing positions this year. So that's what we're looking for. You know, you don't want something that's just going to be completely ramped up already and you're buying at the high. There's no FOMO here. So, and that's what you don't want to see, right? This is when I got added to the S&P, the curse. But here we are back down here. But I digress. What I'm focused on here, what I'm trying to get across is that this gives me exposure that if travel picks up, that's great. If travel doesn't pick up, that's great too, because I have exposure through Barstool Sports, which is just going to simply keep growing, and that brand's going to keep growing. Now, here's your major support right here. Broke it, undercut, and now it looks like you're going to bounce over it. Once this trades up, and eventually it will trade up, if it can get up over into this level, that's not a bad move, just there alone. Just to go retest the top of that 70, right, puts me at like 36%. Now, we're coming into earnings right after Christmas, okay, and we're going to get into that in a minute. But let's go look at this on the weekly and the monthly. So you can see the complete utter breakdown, right? The reversal right here after the S&P ad, tries to rally, breaks that bar, and then that's it, complete washed out. Let's look at the monthly. Okay, now that's interesting, isn't it? So this is why we always look at multiple time frames, right? So let's talk about this for a minute. As we've seen in our previous videos, when we learned about Morningstar patterns and candlesticks, what's going on here, right? So I have a almost perfect Morningstar with this almost being a dragonfly pattern, right? And by flipping this level, oh, that pegs me right to this level. Okay, that would complete that Morningstar pattern. Well, how does that fall in line with this? Well, that's pretty much right on point. It's actually up here a little bit more. But that fits perfectly into what we were just talking about. So that's the technical side of it. You know, I expect that to flip. And we'll, as I talked about in the previous video, when I did the flow chart, I got into how we're going to add and how we're going to subtract. And you know, you're going to want to make sure you subscribe to the newsletter. There'll be a link at the end. Just click the helmet. It'll take you to the newsletter. It's free because I'm also going to update in there periodically the moves that we make on these positions. So let's just jump into this because this is somewhat interesting, and I'm going to give you a really quick tip here. So in going through the data points, I wanted exposure to the online gaming market. So I went through a litany of stocks to figure out which ones make the most sense. Penn made the most sense. I'm just going to point out something in a minute. But we're looking for 1.49 billion in sales for the current quarter. Okay, these are your estimates, so that's right in line with what we're expected. Same time last year was a billion. So that's enormous growth if that happens, of 44.7% on this company. That's not a small number. That's not a small growth number. So I think it's important to understand that. Now, what we want to look for when we buy a company, we have to realize that we don't have the resources that institutions have, okay? So what we want to look for is, are institutions buying the stock or are institutions selling the stock? And that can help us make a decision. Why? Because if they want something that we have, they're going to pay up for it, okay? Just think about it like that. Now, if you take a moment and just go through this, hedge funds have recently modified their holdings of the business. Sanders Morris purchased a new position in Penn Gaming, $1.7 million. It's not small, okay? Capital Partners acquired new stake, $9.8 million, okay? TreeQuant increased their stake by 122%. Okay, walks you through the numbers. Cube Research increased their stake by 241%. Now they own almost a quarter million shares. Okay. Now, Public Employee Retirement of Ohio boosted their stake 1,990%. Okay, now they own 8 million of the stock. All these companies are doing this because they're crunching the numbers and they have research teams that are telling them that they should be leaning towards this. Okay, they have to buy early. They can't buy late because to them it's like turning a ship, right? For us, we can maneuver around. They can't maneuver around. So they need to get in there, crunch the numbers. They can't wait for a technical break all the time before they're going to get in there, especially pension funds. They can't do it. So after reviewing that and taking a look, this one was on the list, and I think it makes perfect sense. So while you're thinking about it, if you could comment below and let me know what you're going to want to see as we cover this over the year. So every week we're going to do a new video on these 10 stocks, and we're going to cover how I trade them real time. But if you can comment below on what kind of data you're going to want to see and how I could make this better, that would be really appreciated, because that's the reason I'm doing this entire video this way, is because of the comments that I got. So I really appreciate that. Make sure you like the video too. It completely helps the algorithm and gets me in front of people. I purposely don't run ads, so it would support the channel if you like the channel. GFS. So let's talk about this. I had reservations when this first came out. Okay, here we go. The next company, right? But in really diving into this was a sickly, brilliant move by an investment bank in the UAE. And it took me a while to kind of figure out what they were doing, but now I understand it a little bit better. Obviously, this is where you went public. This is your move. You broke out from here and you just went. And it's done nothing but act perfectly since then, and there's very little to say about that. Now, why now? Well, Foundries, for those that don't know, semiconductor chips, wafers, they're made at Foundries. Now, you need a foundry in order to manufacture chips. That's what you're going through, the chip shortage. The chip shortage you're going through, right, is more of the high-end specialty chip, okay, area. What you're going to find here is that Global Foundries has a very specific market, and this market is in enormous demand. So we're going to get into that in a moment, but from where we're trading, we're just forming this enormous base. Now, these do not have, even if they have huge earnings, their growth rate, okay, it's all based upon capacity. But the fact that they're operating in the U.S. and plan to expand in the U.S. when we're having all these geopolitical uncertainties right now, and we're having, supply issues, is enormous. And you're seeing massive demand. Remember in the first video how we looked at NVIDIA and how they basically just came out and said to Taiwan Semi, here's $3 billion. We want all your chips. We want everything that we can get. Okay, so we're seeing that happen here on the same scale, but it's kind of interesting how they're playing this out. So let's get into it. So Global Foundries debuted, this was October 30th when it debuted, valued at $25 million. What's fascinating to me is that valuation, and I'll explain a little bit why. But when they came out, and let's just review this part, okay? I think for the better part of the next 5 to 10 years, we're going to be chasing supply, not demand. Global Foundry CEO said in an interview, his clients are Qualcomm, MediaTek, NXP, Qorvo. All right. Automotive companies, appliance makers have been struggling for months to obtain enough chips for building production, right? Products. We know this. Apple came out and said they're going to miss out on $6 billion in sales because they don't have chips. Okay. Intel's blaming lower CPU sales on shortages in supply chips. But the shortages aren't for advanced chips that use the latest manufacturing methods. Instead, the shortages are for what often called the legacy nodes, or semiconductors that use older technology to perform functions like power management, connecting displays, or enabling wireless connections. Those are the kinds of chips that Global Foundry, a third-party silicon wafer foundry, specializes in. Okay, so they're in the sweet spot. Okay, now let's just go down here. There's been that's where the bigger part of the shortage has been. There's been underinvestment in that. For me, we're happy to let the bigger companies serve that single nanometer market, and we'll be the very best at our differentiated technology. Okay, that's exactly what you want to look for. Now, for those that aren't aware of foundries like Taiwan Semi, UMC, Global Foundries, everything is based upon utilization rate. What's utilization rate? Are the machines running? Are they cranking out? Okay, they need a high utilization. So 84%. That's kind of slow for a foundry, and that's based upon the pandemic as stated here. Usually you're at 90, 95, okay? The fact that they're saying that they're over 100% since August 2020 means that their earnings are going to be greater than people think they are. Now, I don't know how much of that's baked into the stock, and only time's going to tell us that. But this walk through Global Foundries made a strategic decision to stop developing bleeding edge chip manufacturing like Taiwan and Samsung and instead focus on less advanced but essential for its clients. Okay, they do have very low margins, this business. The fact that Global Foundries is saying that their records are 11% is huge. This is usually a single digit kind of business, just to put it in perspective. So of the $2.6 billion raised on the public markets, $1.5 will be spent on capital expenditures. Capital expenditures to increase capacity to fulfill demand. In other words, we're taking all of our revenue and we're dumping it back into the company. It operates plants in US, Germany, and Singapore. Global, and we don't care about that, but this part I want you to pay attention to because it's very important. The company is still over 85% owned by Mubdala. I'm going to butcher it. I just butchered it. United Arab Emirates State Investment Fund. Okay, so UAE Fund, all right, their investment fund, which is enormous. They took control of the company when AMD spun off its manufacturing arm. Now, just remember this statement for what I'm going to show you in a minute. They took control of the company, okay, after AMD spun it off, became Global Foundries. Now, they'll reduce their ownership stake, 85%, in the coming years. Over the next 5 years, very orderly and transparent way, we'll take some of their ownership off to get more balanced. All right, let's just focus on this next statement. AMD expands global foundry deals, locking in 2.1 in wafers. So in other words, they spun the company off at the time of spinning it off, right? Now they're coming back and they're cutting $2.1 billion deals with them. This was 4 days ago. So let's just go through this. AMD has agreed to buy more than $2 billion worth of silicon wafers from Global Foundries through 2025, an increase of about $500 million over its previous agreement. This deal allows AMD to lock in additional supplies ahead of time. So they spun the company off, and now they have to go back to the company and pay them more money. So it's a pretty fascinating thing. They're not the largest. They're the fourth largest. But what I like about it, they're under Samsung, UMC, Taiwan Semi. But what I like about it is they're in the U.S. and they're going to expand in the U.S. as well as through Europe. So that's very important because the majority of these places are in Taiwan or are in Asia. And that exposure from a supply chain and geopolitical chain will really drive the market. Now, what we're going to focus on now is just legging into these positions. And as we leg into these 10 positions, again, if you haven't watched it, watch the next video because that's part 1 of this, because you're going to want to follow along, and make sure you click the button, subscribe to the newsletter so you can follow along with our trades. Everybody have a great 2022. Any questions, please reach out. Trade sharp.